Like any other investor, closed-end fund investors should first consider the asset class that they want to be in. So, do I want to have exposure to senior loans or national municipal funds? And then, once they've kind of made that decision, it's, what vehicle, what kind of wrapper do I want that exposure to come in? Do I want it in an open-end fund? Do I want it in a closed-end fund, an ETF? And if it's in a closed-end fund, a lot of times the question of leverage. So do I want leveraged exposure to this asset class? If you want leveraged exposure, that's probably when you want to move toward a closed-end fund. 2017 was a great year for most closed-end funds. And in 2018, we've already seen the return of market volatility, which is affecting discounts. Discounts have tended to get wider so far this year with closed-end funds. And a lot of that has to do with investors pricing in the effects of future anticipated interest rate hikes by the Fed, and what that's going to do to their distributions because leverage costs could increase. A lot of that, I think, is actually fairly well priced in. A lot of closed-end funds pay, because of the leverage and because of the illiquidity of the underlying assets, pay a much higher distribution than, say, you could find in a similarly invested mutual fund or ETF. That's because leverage is still accretive to earnings, therefore still beneficial to their distributions, even though distribution or leverage costs have gone up a little. A lot of closed-end fund investors do come to the closed-end fund space because of the income that closed-end funds can provide. Most closed-end funds have been designed from their inception to provide income. Income is actually the primary investment objective. So I think most closed-end fund investors are in it for two reasons. One, some sort of valuation-oriented trade, shorter-term investment that they're looking to hopefully make money on. Longer-term investors typically come to closed-end funds because of the higher level of income. Yeah, so in the work that I've done over the years, looking at closed-end funds and a lot of the data, anybody who's building an income-oriented portfolio for retirement should consider closed-end funds for their portfolio. It's a well-known fact that individual closed-end funds are more volatile than, say, a similarly invested mutual fund. A lot of that has to do with the leverage. But then when you put that into a portfolio context, most of that kind of fund-specific risk, if not most, if not all of it, gets diversified away because of the portfolio diversification effects. So also, when you're in retirement, risk takes on a different meaning than what it means when you're in your accumulation phase. Risk in retirement is, I'm trying to get to this much level of income, and the risk is that I fall short. And when I say income, I mean cash flow generation. But I want to get to this level, and I fall short of that level. So something in my lifestyle needs to change. Closed-end funds, typically adding them into a portfolio, can help mitigate that risk.